Hey there, how's it going? This is Seth from REtipster.com, and in this video I'm going to show you a Excel spreadsheet that myself and an Excel wizard that I know have spent many hours trying to put together. And the idea behind this spreadsheet is to sort of act as a retirement calculator specifically for real estate investors who are investing in buy and hold properties that throw off income, properties that people plan to own as long as they live. And the reason I wanted to make this is because I don't really know of another calculator out there that does this specifically for real estate and includes all of the relevant details in numbers and factors that can affect the end result. There's thousands of these things out there for investing in like stocks and bonds and mutual funds and all that, but nothing for real estate. And I actually had made something like this, a much simpler version of it several years ago. But the problem with the original one that I made is that it wasn't accounting for things like depreciation and federal and state taxes and whether the value of each property was appreciating from year to year. And all these variables are actually kind of a big deal because they affect the end result in a pretty big way. So that's part of why this thing took so long for me to make. So just at first glance, this probably looks pretty intimidating just because there's so many numbers here. But for most intents and purposes, the main columns you want to focus on here are these ones over here on the left and then these over here on the right. A lot of the stuff in the middle that's grayed out, it's all definitely important and it all plays a part in arriving at these end numbers. But for what we're doing here and to keep this from getting too crazy and confusing, we're just going to focus on these on the left and these on the right. So it all starts up here where you have to enter in some assumptions. And one thing I'm going to say right off the bat is that with this kind of calculator, it's impossible to portray 100% reality because nobody really knows what the future is going to hold. Nobody knows where interest rates are going to go or how quickly real estate is going to appreciate, if at all. Lots of stuff like that. So just keep in mind as I'm going through this, I realize it's not perfect. So starting right up here at the top, we need to put in what we think the cash on cash return is going to be for every property we buy throughout the entire span of our real estate investing career. What you're seeing is the entire span of a person's real estate investing career. So in year one here, if a person was say 18 years old at year one when they started investing, down here at the bottom at year 60, they would be 78 years old. And that's when the calculator just sort of stops. And then right over here where it says new principal investment. So this is the amount of new principal money an investor is deciding to invest in their real estate portfolio each year. In this case, right off the bat, I have it set at $5,000. And obviously with an asset class like real estate, it's impossible to invest perfect chunks of exactly $5,000 every single year. In reality, a person might have to save up $5,000 per year for, I don't know, 2 or 3 years, and then use that as the principal injection for a larger deal. So I realize it's not always going to be that perfect, but in order to make this calculator work, we have to make that assumption. So if I were to change this to say $10,000, that would change all of this. And then the cash on cash return right up here at the top. So that's exactly what it is. It's the cash on cash return that we are expecting to make every single year from all the dollars we invest. Again, it's never going to happen that consistently or perfectly, but we got to make a broad assumption here. 15% is a pretty darn good cash on cash return. I've actually gotten better than that on a number of deals in the past. And I think it is actually possible to do that in a lot of markets if somebody is really good at finding deals and managing this whole process. But it's also a little optimistic. I might bring this down to like 10 or 12%. Because that's kind of a more common reality that people encounter. But again, you can make that whatever you want, and it is going to have a major impact on all these numbers. For the interest rate here, so what we're doing here is we're assuming that every single property we buy is going to be financed. And we're going to assume that the interest rate, again, over the entire 60-year period is always going to be 5%. Depending on who you ask and depending on what kind of market we're in right now, that may be a little optimistic or pessimistic, but I think it's an okay average to use for now. And we're also going to assume that all of the mortgages or loans for each of these properties are going to be financed over a term of 30 years. If we wanted to change this to 15 years, we could do that, but I'm just going to leave it at 30. And the injection amount, I'm going to assume that every single one of these properties is going to require a 25% injection. And depending on the type of property you buy and whether you're going to live in the first property, it may not be nearly that high, but but 25% I think is a pretty conservative estimate. And this next cell down here sort of works in conjunction with the one above it. So whatever we put up here as the injection amount, the opposite is going to show down here. So if we lower it to 20, this is going to show 80. If we make it 10, it's going to say 90. You get the idea. So, but I'm just going to leave it there at 25%. And then the withdrawal for living. So this happens a little bit later on. Whenever the day comes that we decide to start withdrawing money from the income that this real estate portfolio is generating, we're saying how much of that annual income we're going to take out. And in this scenario, I'm going to say that when that day comes, I'm going to withdraw 50% of the income. So you can obviously change this to whatever you want. You could make this 100%. You could make it 0%. It's up to you, but I'm going to keep it right there at 50. And moving on down here, so these are actually the new things that I added to this calculator that make it a lot more realistic and also a lot more complicated. But first of all, right here, so real estate on average historically has appreciated in value, and we need to specify how much we think it's going to appreciate. Whatever that number is going to be, it can vary a lot depending on a number of factors, the market, the property type, lots of different things. But according to Zillow, just looking at a really high level, home prices have appreciated nationally at an average annual rate between 3 and 5%, depending on the index used for the calculation. So just using those numbers, I'm going to go right in the middle and say 4%. For the federal tax bracket, I've actually got a link that you can check out in the comments here, and the same goes for the state tax bracket. So this depends on you personally, what federal tax bracket you're in and how much you have to pay in state income taxes, if at all, depending on what state you're in. And for a lot of people, over the course of 60 years, their federal tax bracket can actually change quite a bit because their income will go higher or it might even go lower in some cases. So again, this is not going to be a static number in reality, but we still have to make some kind of assumption because it's going to use that number to deduct both your federal and state taxes so that we're showing a realistic number at the end of the day right here in column J, showing how much money you actually have to save or reinvest or spend after your taxes are paid. So whatever numbers you put in here, that's going to determine that. And in terms of what your number should be, again, you can check out these links to get a better idea for where you fall, or you can just ask your accountant and they'll tell you really quickly. Moving on down here to the depreciable amount. This is an important number when it comes to factoring in the depreciation cost. And this is kind of a big deal in real estate specifically. And it's a cost you can't write off for a lot of other types of investments. And it can actually save you a lot on taxes because it's a phantom expense. And whatever number you put in here actually kind of depends on what the land value of that property is. And the land value is calculated a whole other way. And I've actually got an article on that as well if you want to read up on how that works. This is also something that your accountant can answer for you pretty quickly. But essentially, whatever the value of the improvements are on the property, you can depreciate those over a number of years. If it's residential real estate, you can depreciate that over 27 and a half years, at least at the time of this recording. That's what the IRS rules are. If it's non-residential real estate, you can depreciate that over 39 years. Again, if you have any confusion about this, just talk to your accountant about it. And also, that depreciable amount is probably not going to be the same for every single property. Sometimes it might be 75%, sometimes it might be 95%. So again, we're making kind of a big assumption here, but it's one of those assumptions we have to make for the sake of having a calculator that's simple enough for all of us to understand. And then right here, you'll basically just want to decide, are you always going to be investing in residential or non-residential real estate? And whatever that number is, you would put that in here. Again, another imperfection, because a lot of people may graduate up to non-residential or commercial real estate throughout the course of their investing career, in which case it's not going to be this consistent, but this is the best I could do. So sorry about that. You kind of have to pick one way or another. But again, that's up to you. Just realize you're sort of making a call one way or another. That's going to apply to this entire calculator for the entire length here of the 60 years. Now getting down here, so this is where it starts to get even more interesting. We have to say how long we want to keep investing this new amount of principal each year. And this is new money we're bringing to the table that's not being generated by our real estate investments. It's like coming straight from our bank account or our W-2 job or our business, and we're throwing it into our real estate portfolio. So you can specify here at what point in time you want to stop doing that. And you might never want to stop doing that. Maybe you want to do it for the entire 60 years, or you might want to stop after 10 years. You might want to stop after 5 years. It's up to you, but whatever you put in there, it's going to affect this calculator right over here in the new principal investment column. So that's where you can define that. And then likewise, whenever you want to start withdrawing the money from this rental portfolio to live on or just spend wildly on whatever you want, you can specify at what point in time you want to do that. You could start doing that after 5 years, or after 30 years, and whatever you put in there, it's going to change this calculator accordingly. So it's totally up to you. And then also remember back up here when it says withdraw for living, this number works in conjunction with this. So whatever number you put in here for when the withdrawal begins, when that begins, it's going to withdraw whatever percentage you specified up here. And then moving on down here, so reinvest profits before the withdrawal begins. These next two ones actually caused quite a bit of confusion and back and forth for us when we were creating this spreadsheet. But it's still important because you may or may not want to reinvest your profits before you start withdrawing. And then likewise beneath that, you may or may not want to reinvest the profits after you start withdrawing the money. So say if you don't want to do it, you can just click no here, and that'll have a big impact over here. And if you don't want to reinvest after you start withdrawing money, it'll have a big impact on that as well. So by default, I just have both of these set to yes because that's what I would do, but you don't have to do that. If you want to make a different decision, you can, and those decisions will have a massive impact on the end result here, which we'll get to in just a second. And then lastly here, offsetting rental income or loss. So this is sort of getting into like ask your accountant territory for sure. I just have this set to no, but keep in mind, if you do set it to yes, it will have an impact over here on the federal taxes and the state taxes. You can actually have like a negative tax credit in some cases. But again, that's getting a little bit into like CPA territory that I'm not comfortable giving anybody advice about. So I'm just going to set this to no by default. There is an article here you can check out if you want to read up on what I'm even talking about here, or again, just talk to your accountant. So with all that explained, let me just show you what's happening over here. With the current variables we have in there, we're going to have a 12% cash on cash return. We're going to invest, let's actually change this to $20,000. I know a lot of people probably don't have that much money to put into their portfolio every single year. I know I certainly didn't, but just to kind of show what can happen here if somebody did. And then interest rate, we're going to leave that at 5%, 30-year mortgages, 25% injection. I think all this stuff is pretty much set to stay as it is. Maybe we'll start withdrawing at 20 years. And let's just kind of go down and see what's going to happen. So over here in column B, this shows us putting in $20,000 per year, and then it just stops at year 21. Not putting in any more money after that. The annual profit, so this is the amount based on what I said the cash on cash return was going to be. So assuming I invest $20,000 and then this is the annual profit I get after principal, interest, taxes, and insurance, but before income tax. That's what this number is right here. And then I'm not withdrawing anything yet. And then this over here shows just the total amount that I invested that year plus any amount I reinvested from the previous year's net profit after taxes. So it's pretty basic that first year. Moving on to the next year though, in year 2. So this is the 12% cash on cash return for the $20,000 I invested in each of the 2 years. So it's actually $40,000 total. Plus it's also showing the amount of net profit that I made in the previous year. And that just keeps going up and up and up and up as we keep going down. And then withdraw for living expenses, there's nothing there. The total annual principal and reinvested after tax profit. So that's basically just showing in that single isolated year, how much new principal did I bring to the table, plus how much after tax profit from the previous year did I invest. And you can see that after tax net profit over here in column J. And the reason this column is important is because it's actually reflecting the reality of not just how much gross income did I make, but how much did I actually have to take home after taxes were paid. And then over here, so we got to remember, we are actually getting mortgages on each one of these, and each of those mortgages are lasting 30 years. So as this goes down the line here in column R, you'll see that the mortgage balance is going up, but some of them are also paying off at some point because that 30-year term is ending. So there's actually a ton of math in this single column to accurately reflect that. So in column P here, what we have is the gross real estate value. So because we're able to leverage our investment, our principal injection plus the reinvested profit, the gross value of all these properties is actually way higher than the amount that we're injecting. But then also there's these loan balances to take out too. And then if you go all the way over here, you'll find the net real estate market value. And what this means is it's taking that gross real estate value minus the mortgage balance, and then it's also factoring in any appreciation that goes into it along the way. So if at any point in time, say in this particular year, in year 40, if you wanted to say, nope, I want to sell all my real estate, pay off all the mortgages, this is the amount that we would walk away with. That's the net real estate equity. And over here on the far right, this column is the net real estate equity plus all of the profit we've made to date, all the money we've made as a result of our activity and our investment. So as you can see, there's kind of a lot going on here, but I think the value behind this kind of calculator is not that you're going to get like a perfect prediction of what's going to happen, but say if you know where you want to be, if you know how much income you want to have to live off of, or if you know how much real estate equity you want to build over the course of time, you can basically reverse engineer your retirement plan and figure out, what do I need to do? What needs to be true in order for me to make this much money from real estate, and in order for me to build up this amount of real estate equity in the future? And of course, if you play around with these numbers even just a little bit, you'll see how very small changes can have a massive impact on the end result. I mean, say if we were to change this to, 8%, our net real estate equity at the bottom here just got cut in half as a result of that one change. So it's pretty significant. If we were to change this to say $10,000 instead, obviously that would also have a major impact. If we were to change our injection amount, that would change things too. And if we were to change the amount that we're going to withdraw for a living when that day comes, that would also have a huge impact, as will all of these things. So it's totally up to you to play around with whatever you want this to be. Again, this is not intended to be like an exact prediction or financial advice or any of that stuff. And always talk to your accountant about any tax-related stuff. I'm not here to tell you what's going to happen in your future or what you need to do or any of that. It's just a tool. Kind of play around with it and just figure out, what do I need to do if I want to get here or there, and if all of these other things turn out to be true. So I hope you find this interesting and useful and helpful on some level. If you want to get access to this spreadsheet and start playing around with it yourself, you can for free. All you have to do is go to the blog post. If you're watching this on YouTube, I'm going to have a link to that blog post beneath this video where you can go download it. If you're already on the blog, all you have to do is scroll down to the bottom of the blog post and you'll see a place where you can sign up for the email list if you haven't already. And then it'll send you a confirmation and welcome email where you can then go to a top secret page on REtipster.com and download the spreadsheet from that page. So thanks a lot for watching. Hope you find it useful, and I wish you all the best as you're mapping out your retirement plan.